Hi, our topic for today is how to protect your stock portfolio, or in a more glamour words will be hedging. Later, I explain to you how do you protect your stock portfolio and how do you hedge against your stock, especially those who are having your stock portfolio. Welcome to our YouTube channel. My name is Ting Ting. Please remember to subscribe to our YouTube channel and please remember to on your notification bell. Now, the first slide that we are going to mention is how do you protect your stock portfolio by what we call as hedging. Especially if you are having your stock, your whole portfolio is very big, then hedging is very important for you. So at the end of today's session, you will understand, for example, if you're having this kind of stocks as for example, A, B, C, D, it can be representing like your stock Asia that you are having, maybe you are having Maybank, CMB, etc. So these are all your stock portfolio. At the end of the day, how do you protect against your stock portfolio? The whole thing. This is what we meant as your whole portfolio. So that is what we are going to cover for today, and how many futures you are going to hedge against your stock. The first thing that we need to understand is what kind of products that you can select to hedge against your stock portfolio. So technically in Malaysia derivative market, there are two products that you can select. The first one will be FKLI, which is your index futures, and the second one will be your FM70. So FKLI is the derivative products for your FBM KLCI, and FM70 will be your 70 stocks. So for example, your FBM KLCI will be the top 30 biggest market cap, and your FM70 will be the 31st stocks until your 100 stocks. So we consider as a mid-cap stocks. So this is your first 30 biggest stocks. This is the 31st until 100. So either you can select FKLI to hedge against your stock portfolio, or you can select FM70 to hedge against your stock portfolio. Now FM70 technically, Bursa Malaysia Derivative, they make an announcement somewhere in April that they are temporarily going to suspend FM70 trading because they are going to restructure the contract specification. So once they restructure and they release it, and you can use FM70 to hedge against your stock portfolio as well. For example, how does this work? Example, let's say your FBM KLCI and your FKL, two things. So one is your underlying, one is your derivative. So let's say, for example, in another layman way of mentioning it will be FBM KLCI is like your parents or parents. So they derive us. We are the futures market, which is like, for example, FKLI. So assuming in a more layman terms, it's like FBM KLCI is like representing your share, the shares that you are having, and FKLI is like representing your futures contract. So first concept that you need to understand is, let's say for example, if FBM KLCI index, they are moving towards downside. So what will be the direction of our FKLI? I give you 5 seconds to 10 seconds to think about it. Think about it. Why and why? Let's say for example, if FBM KLCI, they are moving towards the south side, what would be the direction for our FKLI? So definitely, I believe many of you, your answer will be lower as well. Why? Because futures, or what we call it as your FKLI, the products, is the underlying, your FKLI is the derivative products of FBM KLCI. So these the underlying products, they derive your FKLI. So without our parents, we're not nobody. So let's say for example, if our parents is hot-tempered, technically we are hot-tempered as well. So it's the same thing. So let's say FBM KLCI, they are moving towards south side. FKLI is expected to go in tandem as well because they derive from FBM KLCI. So their direction should be the same. So let's say we use a very small figures for example. Let's say If FBM let's say I own the stock, then subsequently I lost 2,000 temporary, I'm having a 2,000 of losses. So what I can do is I can make it back from futures market itself. So it's like a contra, or you knock out. So whatever you lost in your stock market, you can use your futures market to hedge. So the whole concept of hedging is like a layman terms, what we call it as you buy an insurance. So when you buy an insurance, your main objective is not to make money. Do you want to claim or not? If nothing happens, you don't want to claim. So when you buy an insurance, the main objective is to protect against any mishaps. So other than that, when you hedge in the futures market, it's because you want to protect your stock portfolio. So it's like you are buying insurance for your stock. So I repeat, hedging as a layman term is like you are buying insurance for your stock. So you can use futures to hedge. How to hedge? Our next slide, we are going to let you understand. But before that, you just need to understand that when your FBM is moving towards south side, your FKI will follow in tandem. So if you are losing money here, technically you will be making money here. So either if you are losing money in your stock, you're going to make money in your futures. If you are making money in your stocks, you're going to lose money in the futures market because you are buying an insurance against it. And when we are going to hedge, normally there are two scenarios. First, when the market is very volatile, technically we are going to hedge. Second thing is when the market creates a lot of uncertainty. When the market creates a lot of uncertainties, meaning what? Meaning we are having a very high risk. That's the time that we need to do a hedging. So this is the first thing that you need to understand. Then the next things that you need to understand is when you are doing hedging, do you need to long or short your futures contract? Now, very simple. For you to understand this or for you to answer this slide or this question is very simple. See, FBM if you're losing money in your FBM which is your stocks representing your stock portfolio, technically, how can you make money in futures? So in shares market or in equity market, technically, you can't short or you can't sell a stocks provided you are going for IDSS or what we call it as intraday short selling, or you are going for RSS or what we call it as regulated short selling in Malaysia. But first thing, there are limited stocks that you can go after for IDSS or RSS. And another thing is not easy for retail to go for RSS because your quantity need to be very big. If not, your transaction fees doesn't make sense. So from that perspective, for example, if you're going for RSS, you need to go and borrow the stocks before you can sell. But for futures, you don't need. For example, if I predict or I forecast that our index is going to drop, I can directly go and sell my FKLI. I don't need to borrow anything. I can sell first, later when the market drops, then I can buy back. So if you can't remember what is FKLI, you can refer back to all our previous video and you can understand better what is futures. So I assume that many of you until this video, you already understand what is futures. So technically, if my FBM is moving towards downside, which is my whole stock portfolio is moving towards negative territory. So what I can do is, there's only one thing. So if this is downside, so how can I make money from a downwards trading market from futures itself? So technically, I will need to short a futures contract. So let's say if I forecast that the market is going to go lower, I go and short one futures contract. So when the market start to drop, I can make money. So let's say if I lost in my equity roughly, let's say about 2,000, I'm expecting to make money from futures itself is about plus minus 2,000. Around that. So I'm not going to go into details about it because there are many things that we need to consider as well before you can have a perfect hedge, but nothing to do about it. We just go a more simple one. So I repeat, very simple. In short, for you to hedge against your stock portfolio, you can only do one thing, which is you need to short FKLI or you short FM70. That's it. So if you own stocks, how do you hedge, or how do you protect your stock portfolio, or how do you reduce your stock portfolio risk, is by shorting a FKLI or shorting a FM70. Before I move to the next slide, the common question that people commonly ask will be, why don't I just sell off my stocks? Why I need to hedge with FKLI or futures contract? The answer is yes. If your stock portfolio is not big enough, you can just sell off your shares. But what if your stock portfolio is very big? It's very difficult for you to sell off your stocks. Then you will need to use FKLI to hedge. For example, let's say our current FKLI is about 1580. If you take 1580 times with 50, is equals to 79,000. So technically, if your stock portfolio is less than 79,000, you don't need to hedge, because you can't short half a contract, or you can't short 0.78 contracts. A contract need to be one contract at least minimum. So technically, if your stock portfolio is not big enough, yes, the answer is you must as well sell off your shares. But if your stock portfolio is very big, sometimes it's very difficult for you to get out from a stocks if, let's say, your ownership is very high, and especially if the stocks itself is not liquid enough, it's very difficult for you to sell. That's the first thing. And later, when you want to buy back the stocks, you might not able to buy back as well. So that's the reason why you need to hedge with futures. But if your stock portfolio is very small, yes, the answer
how many
is
contracts do you need to hedge
stock, or how many contracts do you need to short, is by looking at this formula. I believe many of you like formula, right? So it's very simple. You don't need to memorize the formula. Whatever at the top will be your stocks related to your stock. Whatever at the bottom will be your futures value. The top will be your stock value. Bottom will be your futures value. So if we are going to look into it, it will be the top part is the whole stock portfolio value. Remember the first slide that I showed to you? So let's say, for example, you have many stocks, then you take your stock price times with your number of shares, then you add all the value of each individual stocks. That is your whole stock portfolio value. Then you divide by your FKLI price. The bottom will be your futures. Futures value is very simple. You take whatever your FKLI price times with your contract size. For example, in this case, FKLI, the contract size is what? 50 ringgit Malaysia per point. Then if FM70, the previous contract specification will be ringgit Malaysia 2. I do not know the latest what will be the contract size, but the previous one will be ringgit Malaysia 2. So it's very simple. Your stock value divided by your futures value. That's it. Now I give you an example. Let's say I'm going to copy or duplicate the previous slide, the first slide. So let's say, for example, I'm having 4 stocks, stock A, B, C, D. So this is the price as per the time that you want to hedge, not as per the price that you bought, as per the time that I want to hedge. So let's say during that time, my stock price will be this price, and my number of shares, each number of shares, then the total value. So I only need to look at the total portfolio value. So let's say, for example, assuming current FKLI is trading at 1,400. You can see, right? It's 1,400. So if you go back to the previous formula, according to the formula, if the current FKLI is trading at 1,400 and my total portfolio value for my stock is 230,500 ringgit, how many contracts do I need to sell in my futures market to hedge against my stock portfolio? So how many contracts do you need to hedge? Look at this formula. you take your stock portfolio value, which is the 230,500, divided by the current FKLI price, which is 1,400, times with 50, your contract size. So the formula would be like this: 230,500 divided by 1,400 times 50. So how many contracts do I need to hedge? It's very simple. I just need to short 3 FKLI contracts. So in short, very simple, if I'm having a stock portfolio 230,500, if I'm going to use FKLI to hedge my stock portfolio, or what we call it as we want to protect my stock portfolio, what I need to do is I just need to go into FKLI market and short 3 contracts, or we sell 3 futures contracts. Until when we are going to lift this hedge is until the level that the market reduce its volatility or is stabilized, the market already stabilized, or else second way of looking at it is when the market is something that we think that is less risk. The volatility is not there, the uncertainty already clear, then we start to lift our hedge position. So when you are going to close this position is when the market reduce its volatility or reduce its uncertainty, and we think that our portfolio is safe, then we can buy back the 3 contracts to close the futures contract and let our stock portfolio run as it is. So hedging technically, in short, is we use it when the market is uncertain or the volatility is very high. Because sometimes if your stock portfolio is, let's say for example, is big enough, you can use futures to temporarily hedge the volatility. Because sometimes, especially, we are not looking at 230,000 of stock portfolio. Let's say your stock portfolio is very big. If you want to sell your shares, sometimes it's not easy for you to sell it. But for futures market, it's easy for you to hedge, temporary, you hedge the volatility. So once you lifted your volatility, your futures market, then you can let your stock to continue run or make money from there. So that is one of the way that you can do. So once the market reduces its volatility, then you can leave your futures. So our session for today will be until this slide, and we are going to see you in the next session. And please remember to subscribe to our YouTube channel, and please remember to on your notification bell. I see you in the next session. Bye bye.